Okay, this is John Vischer. We're going to go ahead and call our meeting to order. As we begin here, we'll go ahead and do roll call. John Vischer, member.
David Rader, member.
William Johnston, member.
Matthew Barker, member.
Diane Wilson, staff.
Very good. Okay, we have an agenda before us. I'd accept the motion to accept the agenda as presented. Do I have a motion?
So moved.
Do I have a second?
Second.
Very good. All in favor, please say aye. Aye.
Aye.
Very good. We have the agenda adopted. We have the minutes from our last meeting. If there's any amendments or changes, I'd like to hear them now. Otherwise, I'd accept the motion to approve.
So moved.
Second.
All in favor of adopting or accepting the minutes from last meeting, please say aye.
Aye.
Very good. Thank you, everybody. Okay, let's go ahead for the presentation from Twin Asset Management. You're up next.
All right. Well, hello, everybody, and good morning. I'm Sam Gerber with Twin Capital, and with me today is Jeff Gerber. I would like to thank the board for having us in today, although we wish we really were in person like normal because we have, I don't know if you can see out the window here behind me, but we have about a foot of snow that we received up here in Pittsburgh. So quite jealous of all of you down in Florida who have much warmer weather, I'm sure. So today I'll go through a quick update on the firm, provide a little bit of an update, and then I'll hand it over to Jeff to talk about the portfolio and the markets and a little bit of an outlook for 2021. So if, Brendan, are you the one controlling the screen?
This is William. I am.
No, I believe that's William.
Okay, all right. Well, thanks, William. Well, I appreciate you doing that. I'll go to, if we could, just to page 3. Given that it is the end of 2020, nearly the end of 2020, we'll maybe do a little bit of a 2020 in review for Twin Capital. So to touch on a couple of the highlights for the firm, we were fortunate enough that we gained 2 new clients in our prime strategy. Recall that's the strategy that we're managing for you, the city of Gainesville. Interestingly enough, for one of those clients, we had a finals presentation the week before everything began with COVID in early March. So we were fortunate enough that we were able to do an in-finals presentation for that client at that time. And then the second client that we gained for Prime so far this year was actually a virtual finals in April. So it was just interesting for us that we are able to say that we now won our first virtual finals in the year of 2020 and COVID. A couple other highlights in 2020. In April, we celebrated our 30th anniversary. So it was quite a proud moment for us here at Twin that we've been in business and have remained 100% independently owned in a boutique firm for the 30 years that we've been in business. The other point that you see here on the timeline in 2020, a little bit more recent, is that we've expanded our product offering. One, as we've grown as a firm, offering our solutions to the wealth management channel, as well as obviously the institutional channel. We've grown with adding tax managed strategies, more geared for taxable investors. But then additionally, and this is the more recent note, that just this month we launched an ESG strategy that we believe will have significant client demand. It's a large cap strategy benchmark to the S&P 500, but we're excited that from a firm perspective as a new avenue for growth. Now, if we turn to page 4, a little bit of an update on assets and clients. So we're nearing the end here at the end of 2020 with over 1.1 billion in assets, as you can see here on the page. Prime, as you can see, is our largest strategy with nearly 700 million in assets under management. Again, this is the strategy that you've been invested in. The couple other points I'll make here, just a reminder that public funds such as yourselves is our largest segment of clients. We work with a number of public institutions ranging all across the country. One of actually the top 5 largest public pension funds in the country. So, we're very proud of the fact that we work with a lot of public pension funds. And, I think that we understand, some of the challenges that go with that. So, we appreciate the opportunity to work with those public funds. Just last point before I move on and hand over to Jeff, I will say we very much appreciate the additional increase in assets that we received last month through your rebalancing program. And appreciate the opportunity to, a couple months ago, provide you the update and our outlook on the equity markets. We thought that was a very unique way of doing it, to have all the managers on and kind of go through their specific asset classes. We also appreciated just being able to participate in that and hear what the other managers of the program had to say. But definitely, very much welcome, and want to note the additional increase in assets and the confidence that you have in us that we received last month. So unless there's any other questions on assets or the firm, I'll hand it over to Jeff.
Great. Hearing none, I'll take over. And William, thank you for controlling the slides. If you don't mind going to page 5, I'll just quickly remind the committee, the Pension Review Committee, and staff of our process. Our Twins. What Twin manages for you is our prime strategy. It's an enhanced index strategy, as you may have noted on the prior page. Even though we're $1.1 billion, we're still the 10th largest enhanced index manager in the country, as ranked by Pension and Investment. So what an enhanced index strategy is, as you know, is it's something that's going to look to consistently over the long term outperform the market, but always stay close to the market. And the way we do that, the way we, our philosophy is really to combine, as you see here on this page, kind of a bottom-up quantitative stock selection model, along with a top-down fundamental tilt process to help us build our portfolio. So we really do look to actively manage the risk of our clients' portfolios on an active basis. We're dynamically managing risk, and we're trying to capture the market trends and the style trends or the reversals in trends. And there's certainly been a reversal of trends here of sort, a beginning in the fourth quarter. So we'll get to that. But that's just an overview. And William, if you don't mind, page 6 will remind you very, very quickly what we're looking to do is buy stocks that are cheaper than their peers, have increasing earnings growth potential and estimates, and have positive quality or high quality or improving quality measured in a number of ways. And so this page simply reminds you of what we're looking to buy on the left side and what we're looking to sell. I mean, obviously, we're looking to sell overvalued stocks, and we're looking to sell stocks that have declining earnings estimates or declining earnings potential or deteriorating quality metrics. Page 7, if you don't mind, William, kind of puts the whole thing together. So we're taking elements of valuation, elements of growth and momentum, elements of quality of a stock. We're combining it into a model. We're bringing our fundamental tilt as an overlay to that process, but we are very much benchmark aware. We are going to give you a diversified portfolio that's going to hold weight in every single sector of the market, and we're going to be fairly neutral to the sectors in the market. But we're going to try and give you a portfolio that again, as we say on the right side of this page, is kind of more than a collection of individual ideas. If you don't mind, on page 8, William, it's just a review of our prime strategy. The prime strategy, again, I've already mentioned, diversified across all GIC sectors. The beta or the market risk is going to be very much like the market. It's going to look, feel like the market. It's going to smell like the market portfolio, but obviously we're only going to hold a portion of the names. We're not holding all 1,000 names in the benchmark, in the Russell 1000 benchmark. But the other point about the strategy is it is a relatively low turnover strategy. When we look to make our tilts or trends in the market, we're doing it slowly over time. And so I'll even get into that a little bit. But the bottom line for your portfolio on page 9, just to spend a minute to give you an overview. Again, we very much appreciate the opportunity to manage money for the city of Gainesville. We were fortunate to get the account started with $33 million in May of 18. In the rest of 18, 19, and early 20, there was $5 million that came out of the account for expenses. Thank you again. Sam mentioned it as well. We do appreciate the inflow you gave us on November 10th of $5 million more. The timing of that was very good because the market, as you know, has been up very nicely in November and even December to date. So over this whole period, your net inflow is just under 33 million. And you could see your at the end of November, you were $44 million. You're up even higher today in December. But over the 30-month period, your account, as you could see, has gone up $10.8 million. And that's a 12.3% return. We have underperformed the market. It's not been an easy market. We certainly talked about that in October, and we'll review it. But the good news is, in terms of in terms of when we were last together, we were last together in October, and in November and December, and this is through December 15th. So through Tuesday's close, your account is up net of fees, both net and gross, because of our special incentive fee that we do offer to the city of Gainesville. But you're up 14.6% year to date. I'm sorry, November, December to date, you're up 14.6%. You're actually up almost 14% year to date through the 15th. But you're up 14.6 in November and December, half of December. And that compares to the Russell 1000 of 14.5%. So you're outperforming that. And if you looked at the S&P 500, that's only up 13.3. And so you're outperforming the large cap market, both large cap indices. And the spread between the 1,000 and the S&P that you've seen November and December to date is actually something that we're going to kind of touch upon here, because it really deals with the reversal that we've seen in the market. But just to quickly review the prime strategy, while we've underperformed for this 30-month period, we've at least generated less risk than the market. We've been less risky. The market's risk is over 20%. Back in 2017, it was 4%. So just to put in perspective how the market risk has changed, but we've been less risky than the market. And if you do, William, if you don't mind going to page 10, just to remind you that long-term, this strategy and is an enhanced index strategy, meaning that its tracking error is close to the market. It's, you could see historically been just around 2%. And we've added about 1.15% of value added, a gross information ratio of 0.6. And so we've added more return to the market. And as you could see on this page, also less risk than the market. If you don't mind, William, going to page 11, just as a kind of an overview, well, we certainly aren't happy that we've underperformed in this 2.5-year period so far. It is worth noting that it's been a tough market for all active managers, and it's been a tough market for all active managers. This page reminds you that the twin prime strategy that you do have does, on average, outperform the median manager most of the time. In fact, on a 3-year basis, which you can see in red, we outperform 93% of all 3-year or 36-month rolling periods. And on a 12-month basis, we outperform 3 out of 4 times, or 73% of all 12-month periods, we outperform the median manager. So at least you have a strategy, just to remind you, that does outperform the median manager very, very consistently on a 1 and 3-year basis. The other thing about the prime strategy that's good to note here, as the market has had a really nice run here, if you go to page 12, William, this just reminds you that the prime strategy, the reason why we're able to beat the median manager most of the time is because we tend to add value in up months, in months where the market is sideways, say from +2% to -2 or 2.5%. And we also add value on months where the market is down big. So this table is simply showing you that on average, we add value. Prime strategy beats the Russell 1000 on average over all months. It wins in up months. It wins a little more in sideways months. And where it does its heaviest lifting is down months. So The one thing I will point out is that, as you know, the market, as we pointed out to you in this 30-month period, is up nice double digits. We've tried to keep pace, but obviously we have not fully done that. But at the same time, there haven't been many down periods, but I do think that going forward, there will be more volatility, continue this high volatility. So we probably will have the opportunity to add some on the downside. If you don't mind, William, just to go through the market environment on page 13. Some of this we touched upon in our letter to the committee when we sent that on October 2nd, and then of course had our meeting later in the month. But just to remind you, the first 3 quarters of this year is very much a continuation of what we saw in 17, 18, and 19. That is a domination of large cap stocks, leading to the least number of stocks outperforming the market for the last 20 years. We've had this year particularly spikes in dispersion, spikes in the spread of stock returns. We've had, with the result of low market breadth, the result of the domination of a few stocks in the market, it's also led to the domination of only 2 sectors out of 11 sectors, at least through September, as we'll show you. And so you've had unprecedented style returns between value and growth, between dynamic and defensive. The good news here, we did discuss it in October. We did say that we do expect the market, particularly in 2021, to get broader. It's already starting to get broader here in November and December. And so is the tide turning? The answer is yes. So to kind of go through things for you quickly, and now I won't go through every page, but if you just go to page 15, William, this is just a reminder of how concentrated the market has gotten. The 5 largest stocks in the market at the end of August became 25% of the market. You could see the 10 largest stocks over 30%. That's only happened one other time. That's only happened one other time. And the 25% for the 5 largest is the largest we've ever seen since 74. It's the largest weight we've ever seen, with the FANG stocks, as you can see here. If you add Netflix into it and you go to page 16, if you would, William, this is just a reminder of the return from January of 17 through September of 30 of 2020. It shows you the S&P in the bottom line, cumulative return, the S&P index, and it shows you the return to the FAN MAG stocks, which you could see the S&P is up 50% cumulatively. The FAN MAG stocks are anywhere up double to basically 6 times that return over that same 3-year, 3-quarter period. The other comment is, by the way, that the 50% cumulative return has all come from March, in a sense, because we hit the low in the fastest bear market ever earlier in the year. So it's been obviously a very strange, a very difficult year. But sitting here today with the market up, 14% or so, it's not such a bad year, obviously, although we had to live through that volatility. But the point here is that on this page is that if without these 6 stocks actually represented about half of the cumulative return over this period. And over this period, 43% of the S&P 500 stocks actually declined, actually had price declines. Another 24%, or 125 of them, roughly had positive returns, but less than the market's cumulative 50% return. And the other thing that happens here on page 17, just to remind you, when the market is so concentrated, so few sectors outperform. So this is showing you for the 3 years ending September and the 5 years ending September that the only 2 sectors that outperform the market are technology and discretionary. And to be fair, if it weren't for Amazon, discretionary wouldn't even outperform. And while these 2 sectors do represent 40% of the market, unfortunately, for an enhanced index manager like Twin, when you're holding 60% of the market in sectors that are losing, it's going to be hard to beat the market in that period. So that's kind of an overview of what's happened. And I'd like to now turn to kind of the tide is turning. So I'm going to move ahead a couple of pages, if you don't mind, going to page 24, if you don't mind, William, because I certainly want to be we want to be cognizant of time. So fourth quarter, what's happened? Well, the first thing I'll say, and Brendan receives our monthly newsletters. I believe now, William, you should be getting our information as well. But just to kind of review what we've been looking at recently, the performance in presidential election years. And while this presidential election has been far from norm, probably the most unique we've ever seen, maybe ever will see, it is certainly the case that the market is behaving as it typically has in presidential election years. And what I mean by that is that historically, while October over all months is a positive month, in presidential election years, October is a negative month on average. November, which is a great month on average all months, is also is one of the strongest months in presidential election years. So from a sign and magnitude perspective, 2020 is certainly consistent. The market was down a little bit in October relative to a huge gain in November. And in fact, kudos to the timing for the city of Gainesville for giving Twin the money on November 10th. I assume you gave the first tranche or you gave out money to others at that time. I will tell you that the 3 weeks, the 3-week performance of the S&P 500 following the presidential election day in 2020 is the second best ever since 1928. The only time the market went up above more than that was in 1980 when Reagan won. So as you could see, it was a very, very strong return in November. The other thing that happened in November, a little bit in October, more so in November and continuing in here in December, is that the market is really starting to broaden. And the best example of that is that the Russell 2000 was up 18.4% in November, its highest monthly return in its 503-month history. Excuse me, back to 79. So the next page, 25, gives you a pictorial or graphical perspective of the trend reversals that we've seen in the fourth quarter to date. This is only October, November, relative to the first 3 quarters that you see in orange. And so when you look at the orange, you could see that the worst sectors for the first 3 quarters were energies and financials, followed by the Russell 2000. Those 3 are the best performing sectors and market segment for the October-November date. Similarly, on the left side of the page, you have technology and discretionary being the best for the first 9 months. And while they are positive, they are certainly underperforming the market quarter to date. So if you could just quickly go to page 26, just so in terms of the tide turning, it's worth noting, as we did here in the second bullet about the sectors, but the other thing that's starting to turn here in the fourth quarter, which we're very positive, very happy about, because as you know, we are tilted a little bit towards value, is that value is starting to really come back. Now, it's interesting that the value rebound has been more focused in a segment of value stocks rather than all value stocks. And so, William, if you just go to page 27, this points out, this little table points out, this is showing you, again, the same kinds of periods. It's showing you year to date in the middle column, the first 3 quarters. It's showing you quarter to date to the left of that. And so if you look at the first 3 quarters of the year, the Russell 1000's up 6.4%. If you're a growth dynamic or growth defensive stock, you won by 2 to 5 times as big or 6 times as big. If you're a value stock, whether you're defensive or dynamic, you lost big. You had a negative return. Just to remind the committee, I think everyone has a good appreciation of value stocks being cheaper, growth stocks being more expensive, but dynamic stocks are stocks whose price and earnings are more volatile or more variable, whereas defensive stocks are ones who have more stability of earnings, more stability of dividends, and in fact, they tend to pay higher dividends, they tend to have higher dividend growth. So when you look at this and you look at quarter to date, you say, okay, well, value's coming back. Yes, value is coming back because the airlines, the energy stocks, the more some of the financial stocks, the ones that more cyclical earnings have done better than the ones that are more stable earnings so far. We do think that going forward, this rebound that we're seeing in value and small cap stocks will continue. We have a long, long way to go. At the end of November, even though value won by a little bit, growth still leads for the Russell 1000 by 33.5% year to date. So there's a long way to go, but at least we're seeing the tide turn, which is good for active management. And again, November and December to date, you're outperforming the market. Just last thing I'll point out is your current exposures on page 28, just to kind of give you a little bit of a flavor, reminding you that your portfolio is very much sector neutral. We're not taking any big bets. I will point out that when we provided you the report, which was the end of September data, that the small little changes we've made to your portfolio have been that we have moved to a slightly bigger underweight to discretionary and technology. So at the end of September, your portfolio was minus 0.8 to discretionary. Now you're minus 39. Your portfolio at the end of September was minus 24 to tech, and now it's minus 94. So again, that's kind of how Twin, we're going to always stay close, but we're just going to tilt at the margin. And as we've tilted towards value-oriented stocks, we didn't really raise the value weight, but we did it through looking marginally at the sectors. So the portfolio is tilted, as you could see, a little bit towards value. We're pretty much neutral on a defensive dynamic, and we are underweighting the largest cap stocks. We do think that the mid cap and small cap stocks will outperform in the coming year. So I know we went on about 20 minutes. I'm happy. We're happy to take any questions that you have at this time. I guess the one last thing maybe to talk on volatility on page 31, just to point out how extreme volatility is. This is showing you the 12-month volatility for the S&P 500 on the right, the Russell 1000 on the left. Notice that the 12-month volatility is about 27%. It's the highest, the third highest it's really ever been in periods. The earlier period would have been the great financial crisis in 2009, and the other would have been the market crash in 87, in October of 87. So volatility, we told you when we were together 2 months ago that volatility would go up, and you could see that little blip up there. The market volatility, even November was high, although you don't mind high volatility when the market's up. We only mind volatility when the market's down. So we didn't mind it so much in November, but I am concerned about the fact that volatility, if it stays high and the market does turn, it could be a little bit messy. But to be assured, we are well positioned for that with your portfolio, and happy to take any questions.
Thank you very much. This is John Vischer. I've got two questions. You can answer them as you so desire. The first, could you comment on some of the upcoming S&P index reconstitution, specifically with Tesla being added? And I forget which the REIT number 500 is getting blown out, and its price shows that. Yeah.
Yeah.
And then could you also comment, if you would, on, I mean, over the last, really since about 96, the number of publicly traded stocks on U.S. exchanges have declined pretty significantly. So you have fewer and fewer opportunities as a public investor to invest in stocks. And I'm just curious, from an academic standpoint, is that changing the dynamics, how money flows and sort of the performance characteristics, since looks like more and more private money through delistings and so forth. A lot of public companies we could invest in years ago are now off the table for a public access. So for both those questions, I'd love to hear your thoughts.
Sure, absolutely. Thank you, John. So in terms of the new companies coming in, Tesla, as you pointed out, John, and as you know, Tesla is coming in at the biggest weight ever for the S&P. It's coming in at the end of Friday, and I will tell you that some people are questioning. I mean, when you look at Tesla's return, it's 800+% return year to date. You look at it, there were really two periods of phenomena. All through the year, there was thought that Tesla was going to come into the market. It didn't in the summer, although it got the boost in the summer by announcing its 5-for-1 split. So it announced its split, its stock, dramatically increased. Then again, here in mid-November, it was announced that Tesla was going to come into the portfolio. Its stock price dramatically increased. I will tell you that the one good thing is that Tesla was already in the Russell 1000, so it's been in your portfolio for well over a year plus. So you've been holding Tesla for a while now, so you've benefited from that. But I will tell you that is it is going to be the biggest change. The REIT that's coming out, AIVT, it's coming out. It is going to change the sector weights clearly of the portfolio. As you know, it will also adjust the consumer discretionary weight. Right now, the consumer discretionary weight has really been, Amazon is the biggest exposure there. Tesla is going to come into the market anywhere around the 7th, 8th largest company in the market. So Amazon at number 3, Tesla's going to give it a good run. So it is going to diversify a little bit the consumer discretionary market return. But I would have to say that it does create dislocations. It creates dislocations because all the index managers that can't buy it, any S&P 500 index manager cannot buy it until close on Friday. So I think that we will see some volatility in Tesla. We'll see some volatility in the consumer discretionary. As a result of this, the price run-up has been tremendous prior to now. So I do think it does create some disruptions and or not dislocations, but some disruptions in the trading a lot of these sector ETFs. And the sector ETFs and the whole issue of ETFs and the whole issue of publicly traded companies, you ask another good question, John. And yes, it is certainly the case, and academic studies have shown that there's just so much less public companies today. Obviously, the incentive to be private, the incentive to not have to deal with all the regulatory reporting requirements is really tremendous. And as you know, with pension fund money, with family office money, with high net worth money going into the private equity market, they are very willing to pay the liquidity, to receive the liquidity premium, to pay by giving up liquidity today to get that liquidity premium. So I think that it has driven the market to a point where, yes, the market has fewer public stocks. And I would say that the problem was exacerbated the last couple of years by the market being led by a handful of those stocks. So when the market is up big, but yet 43% of the market is actually declining, it's not always a fair estimate for people to be looking at stocks from a stock picking basis. But the good news is, I think part of the offset to the fact that you don't have as many public stocks out there, part of the offset is the growth of ETFs. There's positives and negatives. Stocks do trade at baskets of stocks, but now people have the ability to go buy groups of stocks that they never had before. So I do think that while the number of individual securities has declined, the ability in the public market for investors to invest across various segments of the market has really increased. So I think there's trade-offs there. I think that there's positive and negative impacts on the market. Obviously, when the market moves, it moves quickly, very quickly. I mean, the fastest bear market ever, I'm not sure, we're going to have, I think that that's something we're going to just have to be more used to. I think the fact the market's going to move quickly and sharply because it moves together in baskets. But I do think that the offset of less public companies is that people now trade groups of companies, if that makes sense. John.
Add to your question, John. So that has been the case and it was the case for a number of years, where there was essentially a dearth of public companies, as a lot of companies were staying private for longer and not IPOing. To put a little perspective on it, really the peak of the number of US listed companies was over 8,000 in 1996. And the low was roughly below 5,000 in 2011, 2012. So that is a massive decrease over about a 15-year span. That part of that was a result of some of the digestion of the financial crisis and some of the challenges, and as Jeff pointed out, some of the regulations that just make it quite expensive for companies to be public. Now, to be fair, a large portion of that really would be seen more so in the small cap market. If you looked at, the Russell 2000 companies, maybe a lot of companies that were smaller and would have gone public have stayed private for longer. And now what we've seen with a lot of the IPOs, and particularly in the past 2-3 years, with a lot of the IPOs and the unicorns that have stayed private for very long and then have come public, they've come public at a larger size. And so even in the past 2 years, there's been a lot written recently because of all the IPOs and success of the IPOs and all the SPACs. But that number of public companies is actually starting to increase again. So as of the end of October, there's now 6,179 public companies. So, it is also something that goes in cycles a bit. And as Jeff mentioned, the advent of the growth in ETFs and other vehicles for investors has, I think, made it, provided more dollars to the market, and has also provided a little bit of a different path for companies that when they maybe now, instead of going public earlier in their life cycle, they're waiting a little bit and coming public later when they have a little bit more of that size and stability. You look at some of those big unicorn and tech IPOs, Facebook, even though it's, now it's been public for a very long time, but even when it had its IPO, it was still a fairly large company, and now it's one of the, the largest in the market. So, it's something that it does go in cycles, and maybe it's coming back a little bit.
Thank you. One just quick question on that 6,179 number. Does that include foreign listed stocks that are on U.S. exchanges, or is that the U.S. only domiciled stocks traded on the U.S. exchanges?
It's the U.S. listed stocks on the NYSE and the NASDAQ.
And Sam's point, John, is a good one, and while there are certainly less companies than there were back in 1996, public companies, the demand, there, in addition to the fact that companies are waiting longer to go public and go IPO, the demand for those has been very, very high, particularly in the last year or two, or a couple of years, suggesting that, again, maybe that tide is turning a little bit, where companies are going to now consider going public again after a number of years of more, much less interesting IPO market.
Great, thank you. Any additional questions from committee members or staff? Seeing none, hearing none. Gentlemen, thank you very much for the time this morning. And we wish you a very Merry Christmas and Happy Holiday.
Thank you. Everyone as well.
Thank you very much. We appreciate the time and having the opportunity to provide you an update today. And I'll just echo those comments from you, John and Jeff. Happy and healthy holidays to everyone. May it be safe, may be joyous, and a prosperous 2021 for all.
Okay. Thank you.
Thanks.
Okay, next on the agenda, we have a presentation from Loomis Sales.
Great, thank you. Good morning, everyone. My name is Matthew Buxton. I'm your relationship manager at Loomis Sales, and with me today is Jonathan Kimbrough, who's product manager for our Discipline Alpha team. Before we begin, this is my first time in front of you, but we did want to pass along our sincere condolences regarding Brian. I knew Brian from a previous firm and was truly a really nice gentleman, and I always enjoyed my interactions with him. So, we wanted to pass along on behalf of Jonathan, Lynn, and the team and our firm our sincere condolences there. I think in terms of the presentation, what we'll do today is give you a brief update on our firm, take you through some updates that we've announced recently, and I'll turn it over to Jonathan. Jonathan will review the portfolio and talk about positioning and outlook as we head into 2021. Obviously, we want to make this as useful amount of your time as possible, so don't hesitate to stop us at any time with any questions or concerns you may have. I'd also like to thank you for your recent contribution of $11 million into the account. We appreciate your continued confidence in this team, the strategy, and our firm. If you go to slide 3, just give you a brief update on the firm itself. If you looked at this slide the last time we were here, the assets were about $270 billion. You can see as of 9/30, they're $328 billion. That's since grown to about $341 billion through the end of November. So really strong asset growth in what has, candidly been a very challenging market. I think that number of growth has been driven in 2 fronts. Number one, obviously by the V-shaped return that we've seen in the broad markets. But in the second and third quarters of 2020, Loomis Sales saw 2 of its strongest quarters ever in terms of client activity, new account fundings, and inflows from our existing client base, primarily on the institutional side. So, we continue to perform well. Our strategies have held up well during this crisis and performed. Certainly, your strategy here has done exceptionally well in 2020, given some really challenging markets, certainly in February and March. And so, we continue to be pleased. I think we would always say we can do better. We're never fully satisfied. But I think overall, given the challenges in the markets and what we saw earlier this year and the continuing challenge with COVID, we're pretty happy with how we've done. No changes to our ownership structure. We're still owned by Natixis. We're in the same sort of multi-boutique manager structure that they've always had. So no change to that. Continue to be a strong parent, supportive of anything we need. Evidence of that is we recently added a European credit team. It's going to be based in the Netherlands. We announced that addition last month. They came from a firm, they managed about $6 billion at that firm. So a very strong, deep and well-resourced team. So we're very excited to add that to expand to our credit capabilities around the world. The other announcement I would say is, we did announce that our CIO, Jay Park, is going to be retiring at the end of March 2021. Jay's going to be 66 at that point and is looking for a new challenge in his life. We're obviously happy that he's able to pursue it, disappointed that we don't get to work with him every day any longer. It's important to note Jay does not manage money. His role is really to oversee, along with our risk management function, our teams to ensure that they're doing what they say they do. So in terms of your investment with the team, there's no change at all. Jonathan can certainly comment on Jay. Jay was very close to Lynn and the team and still is. But in terms of a day-to-day management of your portfolio, no changes at all. David Waldman, who's our deputy CIO, will be stepping in as CIO at the end of March. David's been in that role since 2013 as part of our long-term succession planning. And so he's been working very closely with Jay and our risk management team in that same oversight function. And we think it'll be a really seamless transition. Before I turn it over to Jonathan, any questions at all on the firm?
No, none at this time. Thank you.
Great. I think we can jump ahead to slide 9, and I'll turn it over to Jonathan, and we're going to talk about a recent promotion on the team, and then we'll jump into the portfolio. Jonathan?
Great. Thanks, Matt, and good morning, everyone. I appreciate the opportunity to give you an update on the Core Discipline Alpha strategy this morning. It was a year that certainly challenged us all on many fronts, but we are proud of the performance of the Discipline Alpha team. I think that's evident not only in our investment performance this year, but also in our continued growth of the team and our growth of our investment capabilities. Matt mentioned Jay Park's retirement. What many of you may not know is that Jay Park was formerly the CIO of IBM, and he was instrumental in bringing Lynn Royer, the head of the Discipline Alpha team, over to Loomis Sales in late 2009. So as we mark Jay's retirement this year, we also mark the 10-year anniversary of the team and the 10-year track record of the Core Discipline Alpha strategy. So it's a bittersweet moment. But over this past decade, Lynn has been successful in taking this investment process that's been in place for over 20 years, replicating it and actually improving it at Loomis Sales. And in this past decade, she's built the team up to now 18 investment professionals and total assets managed of over $16 billion. The first hire that Lynn made in 2010 was Seth Timon, and you'll see him listed here as a credit portfolio manager at the top left of the page. I'm delighted to let you know today, and it's public knowledge, that Seth will be promoted to co-head of the Discipline Alpha team effective January 1st. Seth's being promoted at this time for his significant contributions to not only investment performance, but his increased leadership. And in this role, he will take on some increased management responsibilities, as well as have ultimate authority for every holding in the portfolio. Seth is a trader, and he will continue to have day-to-day trading and portfolio construction responsibilities, but he will trade a few of those, transfer a few of those industries to our other traders, Mark and Brian, to help free up some time for his increased responsibilities. Lynn has no plans to retire, and she believes that this co-head structure is really beneficial for long-term succession planning and for business continuity. So we're very excited to have Seth join the team as a co-head. In addition to that, we've also hired 4 more junior team members this year to help build out our capabilities with investment analysis, the development of our quantitative tools, and support our trading management. With that, maybe I'll just pause and see if there's any questions on Seth's promotion or the team. Hearing none, though, sorry. Okay, great. Yeah, to Matt's point, the investment process remains largely the same on our side. We just have to make a few tweaks to our risk target setting process, where Seth now is able to break the tie in the case of a credit sector risk decision, where Lynn will continue to have that tiebreaker vote on our securitized side. Total assets for the platform were $16.6 billion as of the end of the third quarter. And the core Discipline Alpha strategy in which you're invested continues to be our largest strategy, with over $8.6 billion in assets. William, if you'd please turn to page 20. I'd like to just show you a little bit of the historical attribution for the strategy. So our core Discipline Alpha strategy seeks to earn the majority of its excess returns through bottom-up security selection driven by fundamental research. We manage a diversified portfolio with highly integrated risk management. And one aspect of this is that we tightly control the duration and yield curve exposure of the portfolio very closely, even so that we're managing this duration during the trading day. Page 20 of this presentation will show you the historical attribution of the strategy since inception. So the top blue line here is total cumulative performance, and you can see that we have generated 89 basis points of gross annualized excess return, with annualized volatility or tracking error of 40 basis points, for a total information ratio of 2.2%. While sector allocation can be a tool for generating excess returns, and it was a bit this year, security selection is the primary driver of excess returns, and that's evidenced by this orange line here on the chart, which takes up the lion's share of alpha generation. Furthermore, any impact from active rate positioning, such as the duration or yield curve, has been effectively mitigated, as you can see by this small -1 number in the rates box. In other words, this is a strategy that keeps duration and sector risk limited in order to allow bottom-up security selection to flow through and be the key generator of alpha. I show you this to give you a historical backdrop for what to expect from the strategy, but to also demonstrate that the more recent performance this year has followed the same expectations. If you turn your attention to page 24, we can review performance of your account through November 30th of this year. Here you'll see that the account has returned 8.89%, outperforming the benchmark by 154 basis points net of fees year to date. Since the inception of Gainesville's account back in 2016, the strategy has earned 42 basis points annualized over this time. The following page shows attribution for your portfolio through the year-to-date period, and I'll primarily focus on the right-hand side of the page here, which has year-to-date attribution results. Consistent with the risk and return profile of the strategy, security selection again was a primary driver of returns here this period. And this was broadly positive across multiple sectors of the portfolio, with credit, mortgages, and ABS being primary drivers. Our sector overweights also contributed to excess return, as you can see, 23 basis points in the allocation bucket. And this primarily came from our overweight to credit, as well as our overweight to asset-backed securities, which is our largest market value overweight in the portfolio. When I think about credit, I just took a look at corporate spreads today, and they're currently at 97. And we started the year January 1st at 90. So if you were to take a look at corporate spreads, it's almost like nothing has happened in the bond market this year, but we clearly know that's not the case. We came into the year already neutral on our credit target when spreads were at 90. And when they quickly rose to 300, we opportunistically took that as an opportunity to increase risk and credit exposure on a single name-by-name basis, and eventually took our credit risk up to about its historical maximum by April of this year. As spreads recovered, we've since brought our credit target down, where it sits now to a more moderate overweight, but our credit positioning and our tactical positioning in and out of that during the year was positive. ABS was a strong contributor to the strategy this year. Our holdings are primarily in high quality prime and subprime autos, which have performed exceptionally well this year as the consumer has continued to be strong. And a lot of our AAA structures had losses built in that were way beyond anything that we've seen from consumer delinquencies. And lastly, from a high level, mortgage security selection was a good driver of returns this year. We found a lot of value in the lower dollar coupons, such as the Fannie Mae 2% coupon. This is called the production coupon, and it was highly supported by Fed purchases. The Fed continues to purchase about $40 billion a month of agency MBS, in addition to $80 billion a month of Treasury MBS, and those were very supportive for those lower dollar coupons in the mortgage market. We do have some individual contributors and detractors listed on this page from the credit portfolio, but I think in the interest of time today, I'll turn to some more high-level portfolio positioning, which could be found on page 27, please, William. Here you'll see our sector exposures at the end of the third quarter, where credit was a modest overweight at 36% in the portfolio versus 32.1% in your benchmark. We continue to hold a moderate credit overweight at this time for the following reasons. We continue to see economic recovery taking hold in 2021. There continues to be very positive headlines on vaccine development and potential for further fiscal stimulus, which could both be positive for the markets. We're also expecting lower corporate supply in the year ahead. 2020 corporate supply dwarfed the last few years of issuance. We've had almost 30% more supply this year and really a dearth of new issues coming to the market. We expect that to be down by about 30% next year, and that lack of corporate bond supply should provide a positive technical for at least a few months of the year, if not more. Low rates, Fed asset purchases, and accommodative policy are here to stay for some time. We saw FOMC meeting notes from yesterday continue to reiterate that the Fed will be accommodative. With that said, corporate spreads are now back near the tights of the year. So it's hard to see as much value when spreads are at tight levels as they were at 300 earlier this year. But we still see enough single name opportunities to continue putting money to work at risk in the credit portfolio. And so we're maintaining a modest credit overweight at this time. With regard to mortgage-backed securities, you'll see we were modestly overweight here at the end of the quarter, 27.3% versus 25% for the benchmark. We're at similar positioning now in your portfolio. With the Fed purchases, we believe those can continue to be supportive for the market. However, we're also balancing that with prepayment risk. With mortgage rates at all-time lows, there still are a lot of people out there that could take advantage of refinancing. That shortens the maturity of those cash flows and can lead to risk. So Timmy and Sadir are watching that prepayment risk closely while they navigate and are choosing specific pools and TBA to help find the best relative value in mortgages. ABS was our largest market value overweight at 14.5% versus the benchmark. And here we're investing a lot of AAA securities that are generally between 1 and 3 years. These tend to have a higher spread and higher carry than treasuries, but in some cases, even on a risk-adjusted basis, they look better from corporates. We saw that ABS this year was used as a source of liquidity in March and April when a lot of clients had liquidity needs, and thus spreads on the ABS market really went to much higher levels. We took that as an opportunity to add ABS to the portfolio, and we have primarily maintained that overweight throughout the year. It continues to be one of our largest overweights and has been a strong performer in your portfolio for the year to date. As we look at consumer delinquencies, we have seen those tick up a little bit, but the structures that we're invested in, which are AAA and primarily senior, are well supported to take any losses from the consumer that may come in the following quarters. I thought I may just touch on a little bit of our credit positioning from an industry perspective before I take some questions, which you can see on the following page 28. We continue to find value in electric utilities right now. That's a very large industry and one good for relative value, as there's a mixture of holdco and operating co structures. But we do find some value in certain California utilities, which, given the wildfire season, a lot of those California wildfire utilities were similarly downgraded despite their underlying risk and rating territories and wildfire risk. So we continue to own some names which we think will outperform other California utilities. Own No Guarantee is a collection of regional champions that are often sovereign linked or sovereign supported names. One of the examples of a name we owe there is Indonesia Aluminum. It's an aluminum producer that is supported by the government of Indonesia, but trades at a slightly higher spread, and we can find good relative value. One of the names where industries we're underweight right now is in the food and beverage space, and I think this provides an interesting example of how we've navigated some of the transformational shifts from COVID this year. Earlier this year, we saw names like Smucker's and Campbell's that make soups and cereals, jams. Those names did very well as stimulus checks went out to people, and there was a pantry restocking effect that led to strong performance in those names. We saw that effect hit performance in those bonds, and we rotated out of those names into something like Anheuser-Busch InBev. They have a global footprint, obviously with beer sales throughout the world. And we felt like that was a name that would initially be able to do well as lockdowns and pandemic lockdowns were becoming more pronounced. Eventually, we discovered that with sporting events and with restaurants being shut down, InBev couldn't quite, was having struggles. And so we rotated into a name like Coca-Cola, which is a single name, pristine credit, which is more able to have direct distribution to homes and pantry restocking. And that name ended up performing well. So just an idea of sense of how these transformational shifts have kept us rotating the portfolio into names where we see the best relative value. Let me pause there and see if there's any questions on our positioning or maybe our outlook for the year ahead.
This is John Vischer. I have one question. It has to do with the rating agencies and your confidence in their level of skill. Obviously, in the last financial crisis, like 0809, there was some questions whether they correctly ascertained. So when you're relying on the credit rating agencies' ratings, how much kind of back analysis are you doing at the portfolio level to confirm what they're telling you or us is legitimate?
I think that's a good question. What I would say is that just because a rating agency attaches a rating doesn't mean that Loomis can't have a different view on that. There are times when we believe the agency has misestimated the risk in a company. Yesterday, we were actually just talking to a JP Morgan strategist. And if you've looked at the downward migration of ratings in the index, say the Barclays Agg, triple B's used to be, say, 30% of that index, and they're closer to 50% of that index now. And we were asking, do you continue to see ratings migrate downward? Are rating agencies becoming more difficult? And we think JP Morgan's answer was that that could be part of it, but we also think they misestimated the risk in financials during the 2008 crisis. So I continue to think there's some skepticism. We'll continue to have oversight of rating agencies, and Loomis will continue to have their own internal opinions on where the direction of that is headed. But our analysts are able to talk with those rating analysts directly, as well as our credit research, to fully formulate a strong opinion.
Great, thank you. Any other questions from committee members or staff?
This
This
is
is Brendan.
oh,
Sorry, Matt, go ahead.
go ahead, Brandon. It's fine.
I was just going to ask a question related to, liquidity, and obviously the Fed has taken some pretty historic action this year with other stimulus measures. Kind of how are you viewing future inflation and some of those pressures that might affect the bond market?
So I'll say that from a macro perspective, we don't take a lot of macro bets in our strategy. We continue to be duration neutral. So in terms of from inflation's direct impact on active rate risk, we wouldn't be taking any rate risk there. Our analysts continue to think there's going to be a while before you see more inflation enter the market, but it's certainly going to be industry dependent. Certainly you see deflationary pressures in the energy industry with energy prices continuing to decline. But you will see inflationary pressures in other areas, potentially healthcare costs. So I think we continue to look on a name by name industry basis to find relative value, and certainly we're more cautious of the energy industry right now with those inflation concerns, and could eventually see more inflation in I'd say retail, maybe even autos, and more consumer goods over time.
This is Matt. Thank you both for hopping on today and going over a few things. My question, I think, is pretty simple, but I think I want to. I think I might know the answer, but I wanted to hear from you guys. As we look at possible more lockdowns across certain areas of the country, what percentage of the portfolio owns anything in those particular areas? California, Detroit, Chicago, New York, upper Midwest type areas. From the governmental space that we would, have concern over?
That's a good question. We do own a few taxable municipal bonds in the portfolio that we've kept a close eye on. One name is the state of Illinois that we've held in the portfolio, and we recently have reduced positioning in that name, but continue to hold it. Another name was the New Jersey Transportation Trust Fund. That was a bond that did trade at a higher spread level, and we continue to monitor that name as well. But if you looked back at the attribution page, you would see that as a detractor for the year-to-date period. So overall, I'd say our exposure to that local authority and the state and local governments has been reduced over the past few months, and we continue to be cautious on a lot of those names.
Okay, thank you.
Great, thank you. Any additional questions for Loomis Sayles from staff or other committee members? Seeing none, again, gentlemen, thank you very much for your good work and presentation today. Is there anything else you want to share with us before we move on?
Nothing from our side, just warm wishes for a great Christmas, New Year, holiday season. And we wish you all the best. Stay safe, everyone. And hopefully this time next year, we'll be seeing you guys in person.
Great, thank you very much.
Thank you. Bye-bye. Have a good day.
Okay, next on the agenda is a report from our friends at ANCO. Brendan, you have the floor.
All right, good morning, everybody. William, is it easier for me to just share my screen, or would you rather drive?
If you can share, that would be fine.
Okay, it says it's disabled. I'm not able to.
Okay.
So I guess with that, I'll start with the 11:30 flash report. If that's all right, we'll just kind of cover what has happened up till now. And as you probably know, the results certainly have been fantastic. Probably not what any of us were really expecting when we were having all these conversations in October. With the POB allocations, I mean, certainly we were expecting volatility, but probably not the positive volatility that we saw following the election. And then probably more importantly, the positive vaccine news. Jeff spent a good bit of time talking about some of the transition in the market, but I think that's somewhat, reflective of especially that vaccine news, as, airlines, retail, shopping, those sectors that have been hit the hardest and also would benefit the most from a return to normal. And I think that's certainly the expectation given the positive vaccine news, or at least the hope. And now obviously we're starting to see that roll out, and I'm sure we're still months away from significant changes, but as the market continues to try to discount that future news, that was really a huge catalyst for the market moving forward generally in the month of November, but also that value shift, towards some of those more cyclical companies, certainly the ones that had been beaten down and have, economically sensitive earnings. So with the page that we're looking at here, you can just see kind of the market value jump, obviously from where we were at the end of October, 570 million up to about 623 million. So a wonderful increase in the month of November. And then the other thing just to point out, because this will be somewhat telling, we started the month with almost 31% in cash, as we had obviously the pension obligation bond proceeds sitting in there. You can see we ended the month with about 121 million, which is still about 19.5%. So a fairly significant amount given how positive the market was. So William, if you would skip ahead to the next page. With that said, you can look at the performance here. Obviously for the month, we were a little bit behind, 9 and change versus the benchmark of 10%. For the quarter to date or the 2-month period, though, we are ahead of the benchmark at over 8 and change, which again, when you consider for the majority of that period, we had somewhere between 30 and about 20% in cash. That is a phenomenal result given how positive equity markets have been. That really was a huge headwind for the portfolio, but over the 2 months, where we're able to outperform. You can see as we move down the page, just in terms of broad category, and again, I'm sort of staying in that quarter to date column. The U.S. equity portfolio did phenomenally. The international was even slightly ahead. Fixed income from Loomis, who you just heard from, was also fractionally ahead, as was real estate. So really all the parts of the portfolio so far over the 2 months really have done very, very well. And again, just the relative underperformance for the month, or just the slighter outperformance for the quarter, is really due to that cash level. But if you flip over to the next page, William, you can kind of see those individual components. Twin, who you just heard from, was again behind for the quarter, although it sounds like from their update that they're starting to outperform a bit here more recently, as there has been a little bit more of that shift. But some of the other managers, particularly those with kind of some value tilt, that had been struggling in the portfolio so far this year, really had a good quarter. So you look at Barrow Hanley, Pzena, and DGI, all performing very, very well over the last couple of months. And of course, again, the contributions that we made early in the month of November were also very timely. When you look at those individual month performance numbers, some of those did extraordinarily well. Pzena's example was the largest beneficiary of the first allocation, and they were your best performer, up over 20%. So certainly wonderful to see that. But again, continued strong performance, certainly out of your international managers. Silchester was down a little bit for the month and quarter, but again, still longer term has done fantastically. And then Bailey Gifford has continued to have a fantastic year. And just for the 2 months, 14.5% versus about 7%. So things, again, probably not what anybody had expected, when we were certainly discussing this over the past, say, 60 days. But it's from our standpoint, a wonderful outcome. Very nice to see that value rotation and not see it in a negative environment. That's one of the fears, to say, yeah, value outperforms, but only when the market's down 10 or 15%. But it's really nice to see a significant value rotation, although it is short-lived so far, but certainly nice to see that in what has been a very positive market. So with that, I'll kind of stop. For the sake of time, I'll run through fairly quickly or leave it there with any questions or comments. And then otherwise we can kind of move on to sort of the current allocation and discussing potentially the next tranche of the pension obligation bond. Are there any questions at this point?
Unless Matt has a question, no one here on the committee live has any follow-up questions at this point.
I do not. Thank you.
Okay. Well, great. So William, if we could switch over to perhaps just the allocation file that shows the actual proposed allocation. So just as a reminder to the committee, taking a look at the current assets, what we've done for the second tranche is just looking at, again, allocating that next 60 million as originally approved in the outline. And then just looking at the actual current allocation. Do you have that, William, available?
Yes, I'm working on it.
I'll just kind of go ahead and start speaking to some of the numbers. So in either the memo that's been updated or the actual allocation worksheet, you can see in the current memo what we're suggesting. All right, I think this will be very, very helpful. So over on the kind of the right-hand side, you can see the December 20 suggested allocation. What we've got there is $11 million to Pzena, $10 million to Barrow Hanley, $10 million to Silchester, $11 million to Bailey Gifford, 4 to Brown, 7 to Twin, and 7 to DGI. And really the basis for those suggestions is if you look at the allocation with those additions relative to the IPS target, what you'll have is approximately a 1.5% overweight to each of those categories. So first, obviously, Twin and Brown combined. Then we've got our large value with Barrow Hanley. Then we get into the smaller and mid-cap stocks with Pzena and DGI. And then lastly, of course, the international managers. And I'm combining those, obviously, 29.3% would be the kind of the new combined allocation if those amounts were used. And then again, when you include this 5% from emerging market allocation, you get a target of 28. So again, we're roughly 1.5 to about 1.3% overweight in each of the equity asset classes, because again, we have to be overweight there in part because we're underweight real estate and underweight fixed income. But in addition to that, we sort of have that 5% alternative allocation that we're currently housing in the equity space. So that's kind of how we came up with those round numbers. It's just really a kind of an even across the board to have each of those asset classes be approximately 1.5% above target. So with that, I'll kind of stop and see if anybody has any questions related to that proposed allocation, given where we are here in December.
Dave Rader is here. I'm pleased to see in your allocations some areas where you do not allocate. And for instance, I'm pleased you're not putting any more in Loomis and you're not doing anything with real estate. These issues up to this point haven't performed as I would have liked, and I've been concerned that you gave them money, we gave them money in the November allocation. So I'm pleased to see we're not doing it in the December.
Yeah, I mean, I think that is important. That the committee definitely had a desire, given the current interest rate environment and future outlook, that expected returns for fixed income were going to be muted at best. But we did obviously allocate in the first tranche to them to really get up to what we talked about as a 1 year cash flow of the pension. So if markets were to become volatile and we didn't want to be selling any of our equities, we would have at least a year's worth of liquidity out of the fixed income portfolio. As it relates to real estate, certainly they're still going through some of those valuation impacts due to the COVID virus. There's certainly a delay as compared to like the REIT or public market portfolio in real estate. And so there's some expectation that there's another leg specifically related to the office market that has yet to be felt in terms of the valuations. We did get impacts from the retail sector in the last couple of quarters, and that's why you're seeing those numbers down a little bit. But there's really been no transactional activity or very little transactional activity in particular in office. And so one of the concerns is over the next quarter, 2 or 3, as some of that transaction activity does begin to take place, that you'll have sort of a second leg down in the real estate portfolio. So kind of our expectation as we sit here, first quarter of 2021 is perhaps somewhere in the June to September range will be a better entry point to look at rebalancing back in. But we do think or do expect some additional softness here over the next couple of quarters as that part of the cycle kind of plays out. So again, that ties back into why there was nothing allocated there into real estate. So appreciate that comment.
This is John. I want to echo Dave's observations and thank you for making some intelligent allocation decisions. And I concur. Looking at the CPI and the Producer Price Index indices, if you go to Home Depot and look at lumber prices, you can see that inflation is starting to bake itself into the process. And so I think that there'll be more interesting entry opportunities for both those two asset classes. So again, thank you for both yourself and staff thinking that through along with PRC. Could you tell, when is the next trade date, implementation date we had on our schedule? I don't have that information in front of me.
Sure. We don't have a specific date, but it's next week. So the idea is, somewhere between Monday and obviously the end of the week, we would be putting that to work.
Okay, very good. So that'll be after this Friday. We have triple witching of a lot of the futures expiration plus the reconstitution of the indices, and that could be for an interesting afternoon of trading. A lot of billions of dollars flying around the globe. So I'm glad we'll have a more maybe settled week the week thereafter. So I think we're good on that.
Correct. And the only other item that really relates in the updated kind of memo that we put together, obviously the original price target or floor, we had put in some catalysts that if the market were to go down would accelerate the schedule in terms of future tranches. So with some discussions, with staff, what we proposed or put in the most current version of the memo is a restate on the floor. So we had put in an S&P level of 3672, because obviously with the S&P going up 11-12% in the month of November, if we left the levels where they were, it would require a 15 to 20% decline in the S&P to get back to that initial trigger point. So I just wanted to make sure the committee was aware that in this current version, we proposed putting in a new sort of trigger point or new floor of that S&P at 3672. So that way, if there's additional volatility beyond, say, next week and the week after, we would potentially be able to move forward with that third and final tranche a little bit faster, as opposed to having to wait for a 15+% decline just to reach that first trigger point. Does that all make sense?
Yeah, it makes perfect sense from my standpoint. So again, so we're clear in terms of line of responsibility, that'll be something that ANCO and city staff will be monitoring. Obviously, we're not going to wait for a special session of the PRC to make that decision. So it gives you a bound of where to make a decision point, and you guys will execute that based on how the world unfolds over the next several weeks. Is that correct?
Correct.
Thank
Yes.
you.
And again, hopefully it's not a trigger point. You know, we don't have this 5, 10, or whatever percent decline, but we just want to, you know, kind of have that in place so it doesn't put us in no man's land, so to speak, prior to a future meeting.
John, just one follow-up question to your comment earlier. I just want to make sure, again, I understand this clearly. You mentioned we have roughly a year's of liquidity built into the, I guess, the bond holding. So, you know, if we had to make some draws from the plan to cover our obligations, and that happened to coincide with some type of significant drawdown on our equity pieces, could you just walk me through that, and perhaps also William talk about how that sort of interacts with us going negative on the treasury account?
Sure, I can speak to that. So we have an internal cash account related to the pension plan, and the balance in that account goes up and down based on employer and employee contributions, and cash flow comes out based on benefit payments, which occur monthly. Through the year, we start off with a positive balance at the beginning of our fiscal year, and then throughout the year, we have a monthly negative cash flow. We expect for fiscal year 21 to be about $2.5 to $3 million a month. We allow that to go negative through the year so that those assets can remain invested in the fund and hopefully earn our 8 to 10%. And then at the end of the fiscal year, we look at the negative cash balance in that account, and we make a withdrawal from the investment accounts to cover it and bring it positive again for the end of the fiscal year. And so that's the amount that we have in fixed income at the moment, with, you know, a buffer for unexpected cash flows.
This is John Vischer again. One question, similar as we're having some pre-thought through triggers for if there's a drawdown, how we fund maybe underpriced asset classes. Again, with the Treasury, if we have a huge run and we think maybe pre-funding that negative balance earlier than waiting to the end of the fiscal year, hoping that valuations coincide with our withdrawal. Is there any discussion or thought on that, perhaps being more opportunistic?
You know, that sort of dovetails into our quarterly consideration for rebalancing. So, you know, when we look at rebalancing, if we've had a 50% run in a class or something like that, then, you know, obviously we're probably going to rebalance away from that asset class and distribute it among other underperforming or less high performing asset classes. Whether we take that and you know, put it in, you know, withdraw it completely and put it into our cash account here at the city, I mean, that's a possibility, but unless we expect a market downturn, I don't think we would do something like that, just because we have that cash available in fixed income on a, you know, on a withdrawal basis that we can make at any time.
And again, that makes sense. Rebalancing, you're right, does cover that. And I guess personally ask, if you get a memo that the market's going to go down, William, could you please give you a phone call? I appreciate that. Okay, Brendan, that's great. What additional discussion that you feel we need to have at this point in time?
No, that's really kind of the main part we wanted to cover, to make sure you saw what those updated allocations were, understood where obviously the current state of the portfolio is. You know, really to understate it, it's performed wonderfully. You know, considering that cash anchor, so to speak, in a period where you've had positive rates, but the portfolio really has done well as of late. Kind of turned this sort of value corner, which we would expect to continue, and certainly we would expect your portfolio to continue to benefit from that overall trend, because generally you have sort of that value bias with those strategies and portfolios. So hopefully that will continue, and then obviously if there's any volatility, we have that additional money to put to work to kind of help buy on some of those dips if indeed we have them.
This is John. I appreciate that. I would characterize the cash not as an anchor, but as a bit of our insurance policy. Unfortunately, the house didn't burn down, so that was I think part of the process. So thank you for those comments. Any other questions from staff or members before we proceed to the next set of agendas? Seeing none. Okay, great. Thank you very much. Okay, next on our agenda, we have some informational items. We were given some preliminary dates from staff. I'll say the only one that I have right now a conflict would be the March 25th. Certainly, the committee is fully capable and probably would do a better job without my participation. But on that particular date, I will be out of town. Are there any other significant conflicts that anyone's aware of right now? Seeing nothing here, William, let's go ahead and book these, and we'll just make adjustments, as we need to in terms of attendance. So thank you very much for that. William, I have two other items before I go. Is there anything else staff would like to bring to the meeting, the committee? Okay. Then I know we still have one member vacancy, so we're working to fill that. If anyone has any colleagues or individuals that have some skill and experience in the industry, certainly we're looking to have as many skilled people on the PRC board as possible. So I know that's something that still we need to attend to. And then I have a kind of an observation, a personal question, and this is really more for William and staff. Obviously, with the very unfortunate, untimely passing of Brian Sargent, we're down a skilled person on the staff. And William, can you give us an update on what we're looking at in terms of maybe restaffing? It's been my observation in the last 20 years of serving off and on the PRC that the staffing commitment and resources dedicated to the pension plan has been decreasing over the years. And I'm just kind of wondering, where are we on that staffing? I do worry about you and others getting overwhelmed with the amount of responsibilities that you have.
I can comment on that, and then the finance director, Cynthia Ramos, may also want to comment on it. We are in the process of advertising for a senior management analyst position to work with me to assist with the pension-related responsibilities of my area. We do tend to focus on the investments, but I am also involved in the actual evaluations, the compilation and reconciliation of that data, submission of state reports, and also some other calculations related to various benefits. I work with risk management to assist them with some of that. I think that the position will be advertised in January, early January, and depending on how the process goes and what the applicant pool looks like, we could have someone in place and by late February, early March, something like that. For the time being, I'm able to handle the workload, and I get assistance from the finance director and other people within the finance department, so that's not a problem.
Great. Well, thank you for that update. Any other questions from any members? One then request specific, William, if you would, given the fact we've agreed on the preliminary meetings, can you send an Outlook invite? It makes it much easier to hit the save button and then input separately. So that'd be great. Everybody else, same thing. Fantastic. All right. I see no other agendas. I see no public participation at this point in time. So if there's no other questions, I'm going to go ahead and ask for motion to close the meeting. Do I have a second?
Second.
Very good. Thank you everyone for your participation.
Thank you.
Happy holidays, everybody.
Same to you, Brendan. Thank you.